Charlie Munger, one of the greatest investors ever, billionaire who also oversees the Daily Journal investment portfolio. They continue to own Alibaba stock, one of their top positions in the Daily Journal portfolio. You can see that they purchased it at much higher prices, so he's significantly underwater with his Alibaba stock. The question is, where does Alibaba stock go from here? A lot of folks have seen this absolutely brutal beatdown with Baba stock over the last year or so, and they're wondering, is it possible that you see a turnaround in the stock? In this video, I'm going to talk about the latest results, the latest earnings results from Alibaba. So let's dive right in. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand what's going on with Alibaba. So once again, they did have their earnings earlier this week. And when you look at Alibaba, you need to understand there's a lot of, funny looking mascots here, and they represent different subsidiaries, different businesses within Alibaba. So you're looking at a conglomerate with lots of different operations. So that's one of the first key points to take away from this. And, you see it with their results. They not only have their core China e-commerce business, but they also have international commerce, local consumer services, thinking about things like actual physical stores or, grocery stores. They also have logistics business, cloud. Their fastest growing segments are their logistics and local consumer services, but their core China commerce business is actually declining 1% year over year. So that is a bit of a red flag. Keep in mind, all figures are in RMB. I'd view their top line results as really mixed. You're seeing low single digit growth driven by the less profitable, less significant businesses, where their core legacy business is flat, suggesting that they're actively losing market share. So you look at their profitability, however, and their core profitability is actually up significantly. So we'll want to understand, well, what's driving that? Because typically you don't see that sort of jump with, let's say, core profitability, when the underlying growth isn't there. So I'd say these results are very mixed. So sizing up Alibaba, once again, recognizing there's a lot of layers here, a lot of different segments, it's important to say, oh, okay, well, the reality is there's a lot of cool stuff here. There's a lot of different business segments, but there's really only one that moves the needle significantly, and that's their China core, e-commerce business, which that's what's generating pretty much all of their core profitability. And you can see in the most recent quarter, it was 44 billion RMB. Their logistics and cloud businesses just starting to turn profitable, up significantly year over year, but still immaterial when you consider the totality of profit that comes from their China e-commerce business. International still unprofitable, local consumer services still unprofitable. But the really key point that I think management is trying to say is, look, no matter what segment you're looking at, we are focused on improving our profitability per segment. And you can see that they're doing that across the board, whether or not the top line is declining or whether or not it's still growing. They're saying profitability matters. And that is a really important data point to see. So let's dive into their China commerce business, because that's really where all their profits really come from right now, the vast majority of it. So looking at China commerce, historically, this is the Taobao, Tmall businesses. They've layered in additional things like Taobao deals over time, Alibaba Health. So there's a lot here, but Taobao, Tmall, that was the legacy core cash cow for this business. And so here's another red flag where they talk about customer management revenue decreased by 7% year over year, primarily due to low single digit decline of online physical goods, the GMV generated on Taobao and Tmall. So this really is an important red flag for investors to consider. That customer management revenue, that's effectively very, very high margin revenue for Alibaba. That's effectively like the commission that they're getting or the advertising spend. It depends on, how it's cut, but this is really high profitability for Alibaba. And they're saying, yeah, this business, this customer management revenue, which historically was high margin, tied to the amount of effectively volume on their platform, where it's very profitable, that declined by 7%. And the broader e-commerce market in China isn't declining by 7%. So this does suggest that their competitors are taking share. And so they will say, well, look, there's softer consumption and there's a COVID resurgence, but they also talk about ongoing competition. And if you look at some of their public competitors, it's very clear that they are growing while Alibaba is not. So that is a red flag that suggests changing preferences for Chinese consumers for the core business that is Alibaba. So that is a really important point for investors to understand. So that is a big red flag. That means you're losing your value proposition, or your value proposition isn't resonating as strongly as it previously was. And that's the goal with this channel, is find those companies with unrivaled value propositions. So they're posting very strong growth and profitability, because if you have a strong value proposition, it gives you the right to win longer term. So that's an important point to understand, the dynamic here, what's going on now. If their core customer management revenue declined by 7%. Well, how come their business that only decreased by 1%? Well, there's a couple of different pieces here. So there's also direct sales and others. So when you're thinking direct sales, that's, a situation where Alibaba will take inventory and then sell it up for a small markup. That is a much lower margin business. You'd much rather customer management revenue to be growing, which is we don't own the inventory, it's high margin business, versus the direct sales, which is lower margin. So if that's the case, well, how come they were actually able to expand their profitability slightly, their EBITDA margins from 30% to 32%? Well, they talk about how some of their current loss-making segments, like Taobao Deals, their losses significantly narrowed, driven by optimized spending and user acquisitions. That's another way of saying they sort of pulled back on some of their marketing spend, sort of saying, hey, we don't need to grow as crazy fast as we previously were for this product, and maybe say, hey, let's just see how things play out. Maybe this is a tougher environment. We're not going to spend as much to acquire new customers. So that's a really interesting point. Management showing that, hey, profitability is an important data point. Okay, so the question is, where does Alibaba stock go from here? Well, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. In full disclosure, this is not financial advice. At the time of this video publication, I owned a small stake in Alibaba stock via the Hong Kong shares. If you're interested in buying, international shares, I personally found that it's easier to do so using Interactive Brokers. There's a link below for Interactive Brokers if you're interested. So let's understand what's going on here. So looking at Alibaba stock, absolutely brutal. Since its IPO, it's actually underwater, it looks like. And this is not the type of thing that gets a lot of people turned on. This is not the straight up and to the right type of chart. This is a, what the heck, you've been wandering in the desert for a long time. What's going on here? But it's interesting because during this time period, it's not like their underlying results didn't go anywhere. What actually happened, since their IPO in 2014 is their revenue has increased by 12 times. And their core profitability is up by 4 to 5 times. So that is a really important data point. So when you see a flat chart while core fundamentals are improving, that is the type of thing that I actually like to see, because that means the valuation is the thing that's come down. Fundamentals have improved, stock price is down. That means valuation has gotten crushed. And that's really what you've seen this past year in Alibaba stock, where any sort of excess in their valuation has gotten completely squeezed out. Now it's arguably in the bargain bin if you're willing to stomach sort of the uncomfortable risks that are China. And there are some very real risks, the risks of, hey, will U.S. investors even be able to own the stock in the future? Will Alibaba stock be delisted in the future? And that's why I own the Hong Kong shares. What happens if there's some sort of geopolitical conflict? Could there be a hot war? If that happens, once again, could you even, would there be forced sellers of these sort of stocks? Do you even want to own something that represents part of the Chinese economy? So there are questions like that. And so I definitely understand why a lot of investors just say, ugh, not for me. I totally get it. But at the other hand, you see investors like Charlie Munger and saying, hey, I think this is a reasonable value. I think it's compelling. And that's the reason why they bought it. Maybe less so about the value proposition and more about just the core valuation. So looking at Alibaba, in the most recent quarter, they're saying, hey, we generated 35 billion in free cash flow. This is RMB, which is up significantly year over year. And you look at, during the first 6 months ending September 30th, also up significantly versus the prior year period, 57 or 58 billion versus 43 billion. So looking at these two data points, you could say, okay, maybe, they're generating 130, 140 billion in free cash flow on an annual basis. And once again, keep in mind, that's free cash flow that can get returned to you as a shareholder. And it's also after all their investments that they're making in their less profitable or unprofitable businesses. So arguably, their profitability, their real free cash flow that you could think about getting returned to you could be much higher from here. So that is a super important point for investors to consider. Okay, well, are they returning the free cash flow? And that's been a key part that I've wanted to see. Well, management talks about how they've been repurchasing our shares aggressively. buying several $billion, using 70% of our free cash flow during the period to buy back stock. How since the period ended, they purchased another couple billion in shares. And so I see, okay, that's interesting, but what's the actual data suggest? And here it is. They said, yeah, we did 35 billion in RMB in free cash flow during the period, but they only bought back 14 billion in share repurchases versus 33 billion in the prior year. This is actually really, really disappointing for me personally, as I look at this, because I've owned a small stake in Alibaba, and I'm looking at this and I'm thinking, wait a second, the stock price has gotten absolutely bludgeoned, in the last few months. The time to be buying the stock would have been now versus a year ago. Last year, you could have been buying it as well, but if you're going to amp up your share repurchases, it should be during this period, especially if you're saying, hey, our free cash flow is actually increasing. So that is another red flag for Alibaba stock that I think investors should be mindful of. Now they're saying, okay, so that's just not, this saying repurchasing our shares aggressively doesn't match with what they did this quarter. But you could say for during the first 6 months, it is closer to that 70% because they did 38 billion in terms of share repurchases versus their 58 billion in free cash flow. So you could say, okay, I get it. Maybe they bought more in the first quarter, and then in the second quarter, they were sort of making up for it, and so they bought less. But all in all, looking at their buybacks, the share count, the diluted share count reduction is only between 2 and 3%. So that also suggests, like, wait a second, that's not the yield that I would want to see as a shareholder. As a shareholder, if your stock is trading at, let's say, a low teens free cash flow multiple, which Alibaba is trading at, and you're buying back using 70% of your free cash flow to buy back stock, that would suggest that you're actually able to retire maybe closer to 6, 7, 8% of the shares each year. And that is not what they're showing so far. They're showing between 2 and 3% decline. So that is another sort of like, what's going on here? How come that's happening? So where does Alibaba stock go from here? Currently, the stock price is around $80. That's for Baba shares. That suggests a valuation market cap around $200 billion, a RMB value of around 1.5 trillion. So 1.5 trillion RMB versus, let's say, normalized free cash flow of 140 billion, maybe much higher when you factor out their unprofitable segments. So you're really only talking about 11 times free cash flow, and that's before a lot of the cash that they have on their balance sheet and investments. When you factor in their cash and investments, you're probably talking about 8 times or lower in terms of the free cash flow multiple. And so if you're looking at that, saying, single digit free cash flow multiple, then they should be able to really buy back a lot of stock. They should be tapping into their cash balances and doing so. So for me, as I look at this, given the macro risks in China have certainly gotten worse than I originally anticipated, over the past year, seeing the leadership and the direction they've taken things, I said, I'm not happy with that. You've certainly seen it, though, with the valuation here. And then you see, hey, they're not only, not buying stock the way I'd like them to, or they're not retiring shares the way I'd like them to, but you're also looking at their value proposition is also arguably not resonating as strongly as it previously was, as they're losing share to some of their competitors. Now, could there be dramatic upside? Yes, because it trades at a lower valuation. But when you look at some of their competitors growing at, let's say teens or greater, some competitors growing closer to 30% plus, there are particular niches within e-commerce. So it is important to say, hey, it's not apples for apples, but it is a competitor sort of biting at your heels. It is concerning. You're saying I declined 1% while these competitors are growing 30%. What's that mean? What's that mean for the years ahead? Because once again, returns are driven by, growth and fundamentals, free cash flow return to shareholders, and valuation. Well, the growth in fundamentals isn't that great. We're talking about single digits top line growth. The free cash flow to shareholders, wait a second, you're saying 70% being returned to shareholders trades at this low free cash flow multiple, but I'm only seeing share count reduction of 2-3%. I want to see that get bumped up to like 7-8% before I start getting excited. Like, what's going on here? Is that a lot of stock, based compensation, or is that a lot of stock also being issued? What's really going on here? So single digit growth, let's say a couple single digits in terms of value, in terms of cash flow going to you. So then the last piece is potential valuation expansion, which in this environment, a lot of people are going to be excited to own Chinese stocks. I'd argue you're going to need to see some sort of changes from the leadership as well as capital returns to shareholders to see that valuation change. Maybe it's possible. I mean, it's certainly, a dumpster dive sort of valuation. When you're saying, hey, single digits for one of the largest e-commerce platforms in the world, you're certainly saying very low valuation. So you could could see, if sentiment changed, let's say over the next 5 years, you could see dramatic upside. Absolutely, hundreds of percent upside just based on valuation, let's say going from 8 times to 20 times. And then you factor in a couple percent buybacks, and then you factor in a couple percent growth. That is how you do pencil out significant upside. The challenge is, what are the pieces that are going to get you there? Because right now you're not seeing the buybacks, and underlying growth really isn't that impressive. It actually suggests that their competitors are doing a better job. So I look at this and I'm thinking, it's interesting to see Charlie Munger, buy something, but as always, or to own something, but as always, you need to make your own judgments. This is, at the end of the day, you're living your own investment journey. You have to figure out what's right for you. I call out what's right for me at unrivaledinvesting.com. Maybe it could be helpful for you. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching.